The following program, paid for by Right Path Real Estate, does not necessarily represent the views or opinions of the staff, management, or ownership of this station. It's time to get on the right path with Right Path Real Estate Radio with Tom Perry. Get the answer to your question that's keeping you from taking action and succeeding today. Get ready. The guy that will put your fears behind you is on the air now. Taking calls at 713-785-1817. Toll free 877-881-0271. Now here's your host, Tom Perry.
Hey, welcome to the show, Right Path Real Estate Radio. Andy's saying he's not hearing anything right now, so let's see if he says, how about now? So hopefully he's hearing something. Hopefully everybody out there in Radio Land is hearing something. Do not adjust your dial. It is not JB in the house today. This is Right Path Real Estate Radio. Normally he's in on Fridays. I do the shows Tuesday, Wednesday, Thursday. We have Build Your Team on Tuesdays and Thursdays, and he and I are together on Wednesdays. He normally does the show Mondays and Fridays. Normally it's Investor Friday. However, he is on the road to Cali. So we'll see what's going on right now. Anyhow, so Nikki, I assume you hear me just fine, right? Everything's loud and clear. So Andy's texting me on the side and saying that he's not hearing the audio. So we'll see what's going on there. Anyhow, sorry if that's the case for you Facebook folks. What I would say is that today I'm going to be talking about what we've been teaching in our weekend retreat, and we've had some shifts. We've been teaching the weekend retreat for the last 2 years now, and what's interesting is that somebody made a comment just about, must have been a week or 10 days ago, something like that, and they said, hey, they're going to be teaching something different in a week. And, I thought about that, and I said, our message does change because the market changes. And what I find fascinating is there are lots and lots of real estate educators out there that are talking about how you do real estate, or how you should do real estate. And for many of them, their message has been the same for 20 years. The problem with that is the market's not the same in even as little as 90 days. So if you're not actively investing in real estate and picking up the nuances to the market that happen, month after month or year after year, the things that worked 20 years ago don't work today as it relates to, I know of an active real estate investor 20-something years ago that was buying single-family real estate, and he was able to buy houses on credit cards. Now, that's really difficult to do today, if not impossible, because it used to be that, it was not uncommon for somebody to have 100 different credit cards in their name as long as they had good credit. And you can go out and buy a house, and if you bought that, paid it off, got it refinanced out, things like that. But now with all the way the credit rules have changed and, the sharing of information and, all of that, that's nearly impossible to do. So if you're teaching, and I know one particular guy, he still gets up on stage, and that's what he talks about, as if you could do that today. And so, so people on Facebook are saying there's no audio, and I have no idea why that would be. I don't. Let's see if that's it. Does that do anything? No. Hopefully we'll get the audio fixed in just a minute. So we're live on the radio, but we'll see. Let's see here. I'm gonna just post here that Andy is working on it. So bear with us. Hopefully we won't lose our entire audience. But yeah, you know what? You're right. I don't see the little bars going up and down. Looks like it's different than. Yeah, Wirecast is not my favorite program, so I'll have to say that. So hopefully he's on there right now, so hopefully we'll have it pretty soon. But back to this. So our message does change as the market changes. And because our message changes, it's because we're doing real estate on a daily, weekly. We closed on, I believe, 3 properties to buy this week, and I think we sold 4 properties, something like that. So we had quite a few closings this week. And we can tell you what we feel like is going on in the commercial marketplace, is going on in the multifamily market space, what's going on for sure in the single family, whether it's buy, fix, and flip, whether it's wholesale, whether it's buy and hold. And so our message changes as the market changes. That's really all it really comes down to. And so, let's see, pressing. So what we're teaching right now in Weekend Retreat, we recognize that there's two paths that we teach people. One is that we teach the path of being an enterprise investor. And what that means is that you want to build this as a business. The second thing we teach is how to do this passively, primarily on the buy and hold side. It's really hard to do. It's not impossible, but the returns aren't going to be the same if you're doing flipping on a passive standpoint. Can you still make some money? Yeah, absolutely. It's typically going to involve larger dollar houses because there has to be enough margin for the wholesaler to be able to bring those deals to you. But So anyhow, so Jeff, to answer the question where Jason is today, he is on a plane to California to go talk to some real estate investors out there, and there we go. So hopefully Andy can get all this up and going pretty soon. So back to what we're teaching now. Essentially, what we're teaching is that buy and hold is the best way to go for building wealth and income. And what you want to be able to do is let's run some numbers. Assume that you had $100,000 that was in a 401k, an IRA, some kind of retirement account, or it's just money that you've saved up over the years. And what you're going to do is you're going to want to put that money someplace. And so when you look at all the different options on where you could put that money, one option is that you could put that money in the stock market. And so let's say you go buy some stock. You're going to pay full retail for the house, or excuse me, for the stock. Let's say you buy, $100,000 worth of Exxon stock, and it would be worth $100,000 when you buy it, and then you're just hoping that a year from now, 2 years from now, 5 years from now, that Exxon stock is going to be worth more money than when you bought it. Okay, so that's number one. The second thing is that you might also hope that there are some dividends that are coming back to you in the dividends that are paid on a quarterly basis. To find stocks that are still paying dividends today is a relatively rare situation. So what we're really looking at then is, compared to putting your money in the stock, if you're going to buy, let's say you had $100,000 to put into houses. Let's say that you divided that $100,000 up into $25,000 chunks, and you were to go out, or even $30,000 chunks. Let's say you go out and you buy a single-family house for $150,000, and you don't buy it at a discount. Now, we can show you how to get houses at a discount. We can also, but I'm saying worst-case scenario, right? You don't even get a discount at all. So you have a $150,000 house. You put 20% down, which is $30,000. Then what you do is, we know that houses right now, because you're buying a $150,000 house, is actually below what the replacement cost of the house is. What you're essentially doing is you're buying an asset value for less than replacement cost, which means that over time that asset value has to appreciate. That's just economics 101. Because the demand for houses below $200,000 is going to continue to increase as the price of building houses continues to rise. Right now, that what we know is a $150,000 house historically over the last several years, and should for the foreseeable future, is going to grow at about 7% per year, which is about $10,500 on an annual basis. Which means that $30,000 that you put in that house just as a down payment on the house, financing $120,000, means that you're going to double your money. You're going to get all of your money in equity alone back in 3 years or less. If you get your money back in 3 years or less, then that simply means that you've outperformed some of the best stocks in the stock market. But wait, there's still more. The other thing that you get is you get cash flow. Because if you have a $120,000 financed on a $150,000 house, you're really only going to have a monthly payment of about $1,000, $1,050, something like that, with principal, interest, taxes, insurance, you could throw in an extra $100 a month for management, and you're in a, let's call it worst case scenario, $1,200 a month. And the house should rent for $1,500 a month, which simply means you're making $300 a month positive cash flow. If you're getting $300 a month positive cash flow on a $30,000 investment, that's $3,600 a year, which is a 12% rate of return on cash alone. So here's an interesting thing. Because of the depreciation on the house, you also get to offset. You get to deduct the cost of the house over 28 and a half years. And you take a $150,000 house over 28 and a half years. We can do the math on that real quick. 150 divided by 28.5. You get about $5,200 worth of depreciation a year. Or if you're getting $3,600 a year in cash flow, you get not only to write off that $3,600, but another $1,600 of other income as well. So you get appreciation, you get depreciation, you get cash flow. Some people would be happy with just the 12% cash flow by itself, because that really acts, for those of y'all that understand tax-free municipal bonds, things like that, no tax-free municipal bonds are paying 12%. So it really would act like a tax-free municipal bond, and you get appreciation as well. We're going to talk about more on this on the other side of the break, and hopefully the people that are on Facebook will have the audio up and going during the break. So we'll be looking at that. You're listening to Right Path Real Estate Radio. You can give us a call, 713-785-1817, 713-785-1817. See you on the other side of the break.
You found or inherited a great investment property. Problem is, you don't know how much it's worth, or more importantly, what to do to maximize your investment while mitigating risk. This is exactly why we started Next Gen Appraisals. Next Gen is a group of appraisers specializing in investment real estate. We understand that investors aren't just looking for a number of what their property is worth, but a comprehensive analysis of the market. Give Next Gen a call at 713-346-9911 or check us out online at nextgenappraisals.com.
Are you looking for an investor-friendly general contractor for your investment property? Then call Fast Track Remodeling at 832-742-9992 or reach us on the web at fasttrackremodeling.com.
Fast Track Remodeling specializes in turnkey remodeling of single-family investment properties, whether it's a flip, rehab, or a rental rehab. No more managing it yourself. No more doing the work yourself. Fast Track Remodeling really does manage it all.
So give us a call today at 832-742-9992.
Time is money in a real estate deal. If your insurance company is slow or non-responsive, you could lose a deal like that. You need a quick turnaround on quotes, binders, and the agency for that is Benchmark Insurance Group of Texas. The team at Benchmark understands the investor mindset. They know what you need and when you need it. It's there for you. Call Houston's leading real estate risk management experts, Benchmark Insurance Group of Texas, 281-569-4353. That's 281-569-4353. Or online at benchmarkbroker.com.
Are you a realtor or seller that is concerned about the new TRID rules and closing on time? I'm Jennifer Hernandez, Senior Loan Officer at Legacy Mutual Mortgage, and we have mastered the 30-day close. We close on time, accurately, and with tons of communication. You'll have a dedicated team of a coordinator and a contract-to-close associate. Give me a call today at 713-579-3611, and let's talk about how we can help you on your next transaction. NMLS 514497.
Selecting a foundation company and their product for repair is a lot like a game of chance. You simply don't know what you're going to get. The foundation repair industry as a whole doesn't carry a license, nor is it regulated. However, Foundation Check utilizes professional engineers to review all of our files to give you the best foundation analysis in today's market. Remember to check before every repair. Call 346-702-3825, or you can reach us online at foundationcheck.com.
Hello, real estate investors. Do you need a lender that moves fast at the speed of a jet to fund your investment properties? Jet Lending will help you purchase properties quickly with as little cash out of pocket as possible. Jet Lending also sets up a repair escrow fund to help you with repair costs. Jet Lending is your fast and friendly hard money source for first-time investors and seasoned professionals. Call 281-872-7800 or email us at info@jetlending.com.
Taxes. Just the sound of that word makes people cringe. At Anderson Advisors, we provide tax reduction through asset protection for real estate investors throughout the country. Our unique philosophy has CPAs, lawyers, bookkeepers, and estate planners with one common goal, helping you, the real estate investor. Check us out today at AndersonAdvisors.com, and don't forget to tell us you heard about us at Right Path Real Estate.
Are small returns getting in the way of your retirement plans? Why settle for mediocre results? There's a better place to invest. The experts agree. Single-family real estate is one of the best investments you can make. Find out how JB Fund Services offers a 9% preferred return and up to a 13% waterfall. Call us today at 281-915-0906 or visit our website, jbfundservices.com. That's 281-915-0906. This investment is offered to accredited investors.
This is Business 1110.
Hey, welcome back. Right Path Real Estate Radio, 713-785-1817. That's our call-in number. You know what we realize is that there is no better time than right now to invest in single-family real estate. You know, the biggest regret that I talk to people that have been investors for a pretty good while, I mean 10 years or longer, is that they didn't buy more houses 20 years ago or 15 years ago or 10 years ago or 5 years ago. Now, knowing that that's the trend, what do you think most people's regret will be 5 years from now or 10 years from now? Do you think people will look back 5 years or 10 years from now and say, oh man, I should not have bought those houses? If I were a betting man, I would say, no, that's not what they're going to be regretting. They're going to be regretting, you know, I bought 5. I wish I'd have bought 10. Or I bought 2. I wish I'd have bought 5. Most people's regret when it comes to real estate investing is they didn't buy more. But Tom, I don't know what it takes to buy a single family piece of real estate. Easy way that you can fix that is come to our free event next Thursday. Go to rightpathrealestate.com. That's rightpathrealestate.com. Go to our free event. Take a look at it. It's going to be at the Crown Plaza that is across from IKEA, and it's easy to get to. It's going to start at about 6 o'clock. There's going to be some really, really good information about how you buy single family, how to find deals, how to fund deals, how to execute on those deals. All of the information that you're going to need to know is all going to be right there. So go to rightpathrealestate.com. Now, so you may say, well, Tom, I've done really well in the stock market in the past. And, you know, what I know is that one of the best investors that, you know, that's ever existed on our planet is this guy named Warren Buffett. And I think if you look at, if I were to Google right now, what's the long-term rate of return? So I'm just going to Google this. What's Warren Buffett's rate of return? And let's see what he says. What's Warren Buffett's rate of return? My guess is it's going to be somewhere between 20. Oh, here we go. Warren Buffett's been an extraordinary investor, but he hasn't been doing as well recently. Shows the calculation for the first 25 years at Berkshire, Mr. Buffett's average annual return was 24% using book value and 30% using market value, compared with 10% for the S&P 500. That's from the New York Times. Now, that's pretty good. In fact, on Motley Fool, it says, I won't keep you in suspense, since Warren Buffett took the reins of Berkshire Hathaway about 52 years ago, Berkshire stock has delivered 155 times the total return of the S&P 500. So that's going all the way back to 1965. So the S&P has delivered annualized returns of about 9.7%, including dividends. But during the same time period, Berkshire Hathaway generated an average stock price gain of 20.8% per year, or slightly more than double that of the S&P 500. In other words, if you had invested $10,000 in the S&P 500 index fund at any point in the last 50 years, the investment would have grown to $10,970 on average after year one. The same investment would have gone to $12,080 after year one if it was in Buffett. But here's the real, what you understand is the compounding effect. Over the last 52 years, a $10,000 investment in a low-cost S&P index fund would have grown about to $1.28 million, which is not bad, but it's over 52 years, right? Until you consider that same $10,000 investment in Berkshire Hathaway's would have grown to more than $197 million. So a small difference in interest rate over a long period of time makes a major, major difference. So here's what I would say. If you run the numbers on a $150,000 house and you bought it at retail and you held on to it and you put $30,000 into that house, then you're financing $120,000. The $150,000 is the amount that's growing at 7%. But you say, Tom, 7% is way below what it is that Buffett got in terms of growing his net worth. But this is the fascinating thing, is that it's the leverage that you get. You're getting a 5-to-1 leverage. So if you're getting 7% on the entire $150,000, which means that that's $10,500 a year in appreciation just on a $150,000 house. So let's say $10,500, and you divide that by the $30,000 that you have in the house. That's a 35% rate of return only on appreciation. If you stack on top of that the 12% that you get in cash on cash, and then the tax advantages that the government gives us in terms of being able to depreciate an appreciating asset. You know, most of the time that you get depreciation, and understand what the idea is they recognize that every year that you own a piece of property, that there's parts on it that are wearing out that you have to replace. So the government says, hey, we recognize that, you know, the life of a roof is about 28 and a half years. So if you have to replace the roof once every 28 and a half years, we're really letting you deduct the amount of the roof that you're losing. So the land and the structure, although it's appreciating, you get to depreciate the structure, which you're really getting to depreciate the entire purchase amount, right? Which is that's the crazy thing about the whole deal, is that you're depreciating the whole thing. Now, I'm not giving legal or tax advice. I want to be clear about that this is not giving legal or tax advice. So, because of that, consult your tax attorney, consult your CPA. But when you compare this to what Buffett's been able to do, imagine if Buffett was able to year after year, month after month, over the last 50 years. In fact, this may be something that I'll do not during the break, but maybe over the weekend, and I'll report back on Tuesday of next week and let y'all know what the status is. But imagine that if Buffett was able to get a 35% rate of return instead of the measly 20% that he got. I say that tongue-in-cheek because it's more than anyone has gotten over the last 52 years, right? And you listen to all the Wall Street pundits and things like that, the reality is they really can't tell you if the end of next week. In fact, you know, they always act surprised. Oh my gosh, we had 6 days in a row of the market going up. Because they don't really know what it's going to do. They have no control over what the market does. Here's what I know is that if you're buying an asset for less than replacement cost, that's one of the tricks of what Buffett did in order to even get the 20% rate of return, is that he would buy assets for at or near the book value of the asset. So the fact that you were getting the business revenue over and above that, that's brilliant, right? But you're doing the same thing in single-family houses. You're getting revenue that gives you a decent return, but you're getting a phenomenal return in the fact that there's more and more people that are needing places to live in certain areas. And fewer ways to create a competitive product to your product. So if you've got a $150,000 house, it's not like somebody else can come along and build a brand new $150,000 house. It's just not possible to do that, which means that older houses that are kept up to date will rise to near what the replacement cost of the house is. Now, provided that, it's near where jobs are and that there's good schools and things like that, and they don't have to be great schools, just have to be reasonable schools. So I would love for somebody to call in, 713-785-1817, and figure out what it is that you want to do with your real estate investing dollars and challenge me. I put out the challenge right now. Let's have a discussion about what it is out there that you could invest in today that is a safe and secure investment. I've heard lots of famous people over the years that have said, "Hey, I'm concerned about the rate of return on my investment, but the number one thing that I'm concerned about is the return of my investment." So it's one thing to go and put $30,000 at work into an investment and to get a return on that. But what's more important is that you're not putting the $30,000 at risk. So we all know of stories of people. I mean, Enron's a great example, right? That people that had hundreds of thousands of dollars in an Enron stock. And you look at all the experts in the day and all that said, "Oh yeah, look at what Enron's doing." So here's a great example of past performance doesn't equal future results. We know people that worked for Enron that became millionaires because of Enron stock, only to watch it evaporate when Enron went down the tubes. In fact, not only did Enron, but the accounting firm that had represented Enron and had done their books and all the other affiliates and associated companies. I mean, I know of people that had provided contract labor to Enron, and it did tremendous damage to their financial picture. I mean, there was a huge collateral fallout. Well, what's the possibility that single-family real estate will ever go to zero? People actually need a place to live. And as long as you need a place to live and you can provide affordable housing, and it's really not rocket surgery. I mean, there's a finite number of things that you can learn, and if anyone was going to invest time in learning how to build wealth and grow their income, single-family real estate, in our opinion, is the absolute best thing to do. Now, the hardest thing about single-family real estate is if you have massive amounts of money. And this is one of the things that's great about being an individual investor versus the big hedge funds and what we call institutional money. We'll talk more about this on the other side of the break. You're listening to Right Path Real Estate Radio, 713-785-1817. That's 713-785-1817.
Did you know that there are over $24 trillion in retirement accounts in the U.S.? Imagine if you could use someone's IRA to fund all of your deals. Well, you can. Quest IRA is based locally here in Houston, Texas. At Quest IRA, we offer retirement accounts that can be used to invest in real estate, promissory notes, private entities, and much more. Many of our clients loan money from their IRAs to fund real estate deals all over the country. We don't sell any investments or give advice. However, we do hold free networking events, weekly educational classes, and free consultations with an IRA specialist. For more information, visit our website at questira.com or call us at 1-855-FUN-IRAs. To tap into the $24 trillion in retirement accounts in the U.S., call Quest IRA at 1-855-FUN-IRAs or go to our website, questira.com.
Are you looking for an investor-friendly general contractor for your investment property? Then call Fast Track Remodeling at 832-742-9992 or reach us on the web at fasttrackremodeling.com.
Fast Track Remodeling specializes in turnkey remodeling of single-family investment properties. Whether it's a flip rehab or a rental rehab, we manage every aspect of a rehab from start to finish with a highly efficient, standardized process.
Over the last 6 years, Fast Track has completed over 700 projects, which has helped us to create our 3 keys to success. Use a detailed scope of work so that everything gets done. Train and maintain quality crews so it gets done right. And complete the work in a proper order so it gets done fast.
No more managing it yourself. No more doing the work yourself. Fast Track Remodeling really does manage it all.
So give us a call today at 832-742-9992. Again, that's 832-742-9992. Or reach us on the web at fasttrackremodeling.com.
Hello, real estate investors. Do you need a lender that moves fast at the speed of a jet to fund your investment properties? Jet Lending will help you purchase properties quickly with as little cash out of pocket as possible. Jet Lending also sets up a repair escrow fund to help you with repair costs. Jet Lending has originated over 2,000 loans in Texas, valued at over $250 million. Jet Lending will help you evaluate your deals for free and give you feedback on value, cost of repairs, and potential loan amount. Jet Lending is your fast and friendly hard money source for first-time investors and seasoned professionals. Call 281-872-7800 or email us at info@jetlending.com. Oh, and don't forget about our famous Third Wednesday Super Investor Networking Meeting. Lots of fun, lots of great real estate talk. We'll see you there.
Are you expecting to close accurately, on time, and with lots of communication on your home purchase? You've come to the right place. I'm Jennifer Hernandez, Senior Loan Officer with Legacy Mutual Mortgage. Our goal is to give our borrowers and referral partners an amazing experience during the loan process. My team believes in putting people and culture before results. Our company concentrates on building those teams who operate with structure, process, and recognition for going the extra mile for you. This way, we have the energy to make this your best home purchase ever. Give us a call today to find out the simple steps to get started. I'm Jennifer Hernandez, the Hernandez team at Legacy Mutual Mortgage. Jennifer.legacymutual.com or call 713-579-3611. Again, Jennifer.legacymutual.com. We can't wait to consult with you soon. NMLS 514497.
Equal Housing Opportunity Lender. NMLS 514497.
This is Business 1110.
Yeah, they're kind of hot. Hey, you're listening to Right Path Real Estate Radio, 713-785-1817. We are having some technical difficulty on the audio side of our simulcast on Facebook. So Andy will have that up and going so that it is synced using the audio output from the radio show. So sometime later today, that'll be up on the Book of Faces. So sorry about that, guys, that follow us along. Maybe it's just, maybe the system showed up and it said, hey, who's this guy on Friday? I've never seen him before. And it kind of locked up and froze out of the security. Yeah, who's this guy? So what we're talking about is, why is it that single-family houses is such a great deal? And one of the advantages that we have is that the marketplace, the stock market, for example, has gotten extremely efficient. I remember when stocks used to be traded in eighths of a dollar. So if you divide an eighth, dollar into an eighth, it's kind of a funky number. It's like 0.125 cents. So it's like 12 and a half cents is an eighth of a dollar, right? Well, how do you do that? Well, what would happen is that there would always be a bid and an ask, and there was normally about a quarter of a point, maybe even a little bit more than that between the bid and the ask. And what would happen is that you could actually become the market maker and make a little bit of a spread between the guy that actually is the market maker on the stock exchange, and people could just eke out these little shavings, from the people buying and selling. But then they went to the dollar system or the decimal to where it's like to the nearest penny. And the spread between there got so small that you really couldn't do it. And then you had these computers that are right next door to the exchange computers, and you can trade online and all that. And the distance that you were in the rack in the server room made a difference on how fast your trade could get executed. And when they were doing all these micro trades. So that's how efficient the market got, is that if you could make money off of doing micro trades, where you're talking about fractions of a cent, added up over millions of transactions in a day or in a week, that you made profit. The real estate market is not that efficient, and so deploying capital if you were trying to deploy $10 million in commercial real estate, you could do that. If you're trying to deploy $10 million in the stock market, you can do that. If you're trying to deploy $10 million in single-family houses, that's more difficult to do, which gives the average person a really great opportunity because of the inefficiencies in the marketplace. It means that it's more difficult for a Wall Street to raise $100 million or $1 billion and go and deploy it with the speed and efficiency that they need to deploy that capital. Because when Wall Street wants to deploy capital, they need to deploy large numbers in order to get a return, and they have to do it fast. In fact, that's the thing that as we've been approached over the years by people that say that they can bring us Wall Street money, they want to know how fast can we deploy $100 million, and they don't ever like the answer because it's not. They want it deployed in less than 30 days, and it's really difficult to go out and we call it equity stripping. There's not enough equity in there to be stripped out to efficiently put $100 million of work or of capital to work in single-family houses. When you stop and think, if the average rental house in Houston, Texas, even if you went with the median home price, I mean, take $100 million divided by $200,000 per house, right? That's about 500 houses. Can you imagine going out and trying to buy 500 houses? And what they want is they want those houses at a discount. You can't buy 500 houses at a discount in a month. Give me a year, I can buy 500 houses in a discount. I mean, we buy 150 houses a year to buy, fix, and flip, and we get those at a discount, a pretty significant discount, but that's 150. And when you look at what it takes from a title standpoint and a meeting with seller standpoint and all of those kind of due diligence on running comps and all that kind of stuff, you can't do all of that on 500 houses within 30 days. For sure not. I mean, can you imagine that? That's a pace of buying 6,000 houses in a year. That's and if you built that infrastructure, would you want to do it for 30 days and then stop, right? And then even if you could, can you imagine the construction crews and all that has to go into being able to make those houses livable? And that's why Wall Street has had a tough time when they started buying. For people that are active as investors now, they know that Wall Street has come in and hedge funds have bought massive numbers of houses to get into the rental business. But oftentimes what will happen is they can deploy the house on the buy side pretty quickly, but then the lag time from the time that they buy the property till they can get crews out to start mowing it and start rehabbing the houses, replacing toilets and fixing faucets and replacing countertops and cabinets and appliances and all of those things, the flooring and all of those things that it takes to get a property up and rentable, it's just not very efficient to do it in large scale. What does that mean for us as the average investor? It means that if you've got 500,000, you've got $1 million, you've got 300,000, you've got anywhere from about $100,000 up to about $10, $15, $20 million. I believe that single-family houses are the best way to go. And even if you were buying the houses retail ready on MLS and you were sticking around the 120 to 170 price range, that with 7% appreciation and putting 20% down on the house, you're going to average about 35% leveraged appreciation on the money that you have deployed. One of the mistakes that I see people make is if they've got a $150,000 house, they think they have $150,000 deployed, but that's only if you pay cash for the house. Keep in mind, these numbers don't work as effectively if you're not wet leverage. I wouldn't get real excited about a 7% appreciation if I had $150,000 in a $150,000 house. And that's one of the big differences between what you can do with single-family houses versus what you can do with the stock market. If I'm going to buy $150,000 with a stock in the stock market, I'm going to have to spend $150,000. I know. I can hear listeners trying to correct me, talking to the radio right now. But, Tom, you don't understand. You can leverage up to 50%. Yeah, I get it. You can, but that also increases your risk because it's very possible that $150,000 with a stock could go to $100,000 relatively quickly. I would say it's not out of the realm of possibility, but it is very much out of the realm of likelihood that $150,000 houses are going to ever drop to $100,000. It just won't happen. Now, is it possible that a $500,000 house may drop to $450,000 or $425,000? Yeah, absolutely, that's possible. Higher end houses will drop in value as interest rates rise. I want to say that again. Higher end houses may drop in value as interest rates rise. Why is that? Well, quite simply, regardless of the price range that you're playing in terms of houses, buyers are payment buyers. So if someone's qualified for, let's say, a $4,500 a month payment, and right now that may buy a $600,000 house, if interest rates rise, that doesn't mean that the buyer now qualifies for a $6,000 a month payment. They still qualify for the same $4,500 a month payment. Well, if interest rates rise, that means that you can buy less house for that same $4,500 a month payment. So what typically happens is that the people shopping for $4,500 a month houses are used to shopping in certain neighborhoods. There's people that are in that neighborhood that are paying $4,500 a month for the house. That's the neighborhood you want to live in. So what typically happens, that means that the houses in those neighborhoods fall to what the purchasing power is of $4,500 a month. Conversely, on the lower end houses, it works a different way. If someone's paying $1,500 a month for a $150,000 house, the landlord, the owner of the property right now, is not paying $1,500 a month for that house. What's happening is he's paid $150,000 for the house, let's say, and as interest rates rise, that $1,500 a month will buy a $170,000 house or a $175,000 house. And the investor only owes $120,000 on the house. And so they're making a $300 or $400 a month spread on the cash flow. When they turn around and sell it, they can sell it for more because you'll have more buyers being able to buy houses. As interest rates rise, who it affects the most in a positive manner is the lower end of the spectrum. When interest rates are really, really low, there's not much appetite for risk for the bond market that buys securitized mortgages. And so what ends up happening is that it becomes really difficult because underwriting gets really tight for the people for lower-end houses below the median. For right now, that's $160,000, $170,000 and below. It's hard for those folks to get mortgages. Is it impossible? No. You've got a good job, good credit, all of that, but it's the ones on the margins. And so as interest rates rise, then the underwriting risks that the investors are willing to take for the return, as the return increases, the investors are willing to take a little bit more risk. I mean, it's not a massive swing in the pendulum, but the more people that you have that are able to buy those houses. So the advantage that you have in single-family houses is that in the future, you really have two exit strategies if you ever want to get out of single-family houses. One is that you can sell to another investor. But the other thing you can do is you can sell to an end-user owner-occupant. So that's an advantage that you have over buying, let's say, commercial retail strip shopping centers or office buildings, things like that, because you'll always only sell those to other investors. Hey, you're listening to Right Path Real Estate Radio. We're talking about the ins and outs of real estate investing. We're talking about practical real estate investing, what we do every day. You can give me a call, 713-785-1817. That's 713-785-1817. We're going to the break. See you on the other side.
Hi, Clint Coons here, attorney and avid real estate investor. You know, the greatest mistake real estate investors make is not understanding the potential liability that exists from owning real estate. At Anderson Business, Legal, and Tax Advisors, we specialize in protecting real estate investors in all 50 states. In addition to structuring your business for optimum protection, we provide guidance so you pay the least amount of taxes available under the law. We have 150 employees that range from lawyers to CPAs to estate planners and much more. Download our free ebook, The Invisible Investor Strategy, today at AndersonAdvisors.com or call for a free risk reduction analysis and financial blueprint at 800-706-4741. Anderson Business Advisors will help you keep more of what you earn. Call us today at 800-706-4741 and mention Right Path Real Estate.
Are small returns getting in the way of your retirement plans? Why settle for mediocre results? There's a better place to invest. The experts agree, single-family real estate is one of the best investments you can make. Find out how JB Fund Services offers a 9% preferred return and up to a 13% waterfall. Call us today at 281-915-0906 or visit our website, jbfundservices.com. That's 281-915-0906. This investment is offered to accredited investors.
You found or inherited a great investment property. Problem is, you don't know how much it's worth, or more importantly, what to do to maximize your investment while mitigating risk. This is exactly why we started Next Gen Appraisals. Next Gen is a group of appraisers specializing in investment real estate. We understand that investors aren't just looking for a number of what their property is worth, but a comprehensive analysis of the market. Give NextGen a call at 713-346-9911 or check us out online at nextgenappraisals.com.
Do you have cracks in your brick, doors that stick, or sheetrock that's coming apart? Then you may have foundation movement. Due to our expansive soils in the Houston area, it's probably not a question of if you have movement, but when. Call Foundation Check for a truly independent, unbiased foundation evaluation. Foundation Check has been in business since 2009 and has completed over 1,400 evaluations. We're not in the business of repairing foundations or selling you unnecessary pier work, but we are in the business of evaluating your foundation. Our product is designed for house flippers, landlords, or even owner-occupied properties. Each of our files is reviewed by a licensed engineer. Remember to check before every repair. Call 346-702-3825. That's 346-702-3825. Or you can reach us online at foundationcheck.com. That's foundationcheck.com.
Time is money in a real estate deal. If your insurance company is slow or non-responsive, you could lose a deal like that. You need a quick turnaround on quotes or binders? The agency for that is Benchmark Insurance Group of Texas. The team at Benchmark understands the investor mindset. They know what you need and when you need it. We're here for you. Are you a rehabber, wholesaler, buy and hold, or flipper? Bundling your properties on a single policy will help save time and money. Benchmark has been in business for over 10 years, and we insure over 30,000 properties. Contact Benchmark about our exclusive investor package. Call us and let us show you what we can do for you at 281-569-4353. That's 281-569-4353. Or online at benchmarkbroker.com. That's benchmarkbroker.com. That's 281-569-4353. Or online at benchmarkbroker.com.
This is Business 1110.
Hey, welcome back. Right Path Real Estate Radio, 713-785-1817. We've been talking about a lot of ideas, and what I'll tell you is I would be hard-pressed to not want to debate somebody about real estate versus any other type of investment out there. If someone can show me an investment that returns 47% a year on the money that you have invested without much risk, man, I'd want to hear about it, that's for sure. If I told you that there was a stock that you could invest that would pay you a 12% per year dividend and it was going to appreciate 35% per year, I mean, there'd be everybody buying that stock. What would happen is it would drive the prices up so much that it would reduce the returns. But that's the situation that we have with single-family real estate right now, is that between 35% appreciation and the 12% cash-on-cash return, and then you have depreciation. And, oh, by the way, there's one more. When you have a tenant in place, every month that your tenant's paying the rent and you're sticking $300 a month of profit in your pocket, a portion of that payment is going towards the taxes, and a portion of the payment is going towards the interest, but a portion of the payment's also going to the principal. So someone else is paying off your mortgage every single month, and eventually you will have 100% equity in the house if you keep it long enough. I mean, when you start looking at all the ways that you can make money in single-family real estate, why are you not getting started? There's only two reasons. Either A, you're not listening and you don't know, or B, you're afraid because you don't know how to get started, or C, you don't have any money because in order to start, typically what you have to do is, the best way to start investing is you've got to first have an income and be able to live on less than what you make so that you can save a little bit so that then you can start investing what you've saved. For those of you that have not read The Rich Dad, Poor Dad, I recommend that you do that. There's also other great books like The Millionaire Next Door is absolutely fantastic. Most people want to get rich. They want to become millionaires, but they don't want to put in the work to learn how to do it. What we're talking about here, it sounds simple. It's really, really simple. It's not rocket surgery. What I get fascinated about is that people at networking events call themselves real estate investors really, really easy. And the barrier for calling themselves a real estate investor is nothing. It's not like calling yourself a neurosurgeon. I can't just walk up to a networking event of other neurosurgeons and they go, "Hey, Tom, what do you do?" "Well, I'm a neurosurgeon." "Oh, yeah? How's that?" Yet people every day go to real estate networking events and say, "Yeah, I'm a real estate investor," and they've never bought a house. Hey, you've been listening to Right Path Real Estate Radio. What I want to tell you to do is go to rightpathrealestate.com. That's rightpathrealestate.com. You want to be at our next event, which is going to be next Thursday. We're going to have a panel of experts. It's going to include Michelle Rodriguez. She's with Next Gen Appraisers. It's also going to have, I believe, Jeremy Humphreys. Is that right, Nikki? No. Benchmark Insurance, Jet Lending, Fast Track, and also Next Gen. So going to be a great event next Thursday. Go to Right Path Real Estate Radio or rightpathrealestate.com and register for the event. Thanks for listening, guys. Y'all have a great weekend. Buy a bunch of houses. We'll be out buying houses. I hope you will too. Have a great day. See you on Tuesday.